you're doing well today. I hope today was a great day for you. There we go. And hope you're not too uncomfortable with market issues and so on, and I wouldn't let that worry you. We're going to talk about that tonight, kind of show you how we are perceiving things, what's going on, and how we'll go forward over the coming year here. So as usual, welcome to Your Financial Journey, where we spend some time each month taking time to talk about how to create, grow, protect, and preserve your family's wealth in today's economy. And this, as the February investor update, we're going to share some information with you that'll make it clear as to what some of your options are. And for some of you, hopefully it'll give you the comfort you need. And for others, it may cause you to say, oh, we might want to make a couple of changes. Either way, we're here for you in that. As always, there's the disclosures. We're required to share these, but I would say to you, I would share them even if I wasn't required to, because as you look at tax issues that are discussed at times, you look at legal issues or aspects of it as they're discussed here, risk and reward issues, etc. It's important that you make decisions carefully and wisely, and that you have all the information to make great decisions as you go forward to create, grow, protect, and preserve your family's wealth. We will have a time for questions and answers at the end. It doesn't mean I can't take a question before then if something's really urgent, but I will give time at the end to discuss any issues that maybe we didn't quite explain or I didn't cover well enough for you. Be happy to do that. You can either A, go to the chat and write your questions there, or B, you can raise your hand and I'll be able to see that, and we will go ahead and take time to answer those questions. So tonight, we're going to take some time to go through the 8 asset groups and our 10 investment concepts. I'm pretty sure that most everybody on here has seen that, so I will kind of speed through that. But we're going to spend some time this evening drilling down on how we manage entry and exit strategies, especially in a market and an economy like we're seeing now, where you might be wondering what's going to happen. Should we just get everything out of the market, or are we okay? Or you're totally good to go and you're like, just stay in, let's add some more. We're going to talk about how we manage from this side of the equation so that you can have some confidence going forward on what we're going to be doing with you, with your family's money, and with your accounts. We're going to take some time also to take a look at diversification of the portfolio management, to remind you again about how we create diversification, how we use diversification to match your risk and reward assessment, and help you to have that confidence during any market issues, any economic issues, so you can feel comfortable going forward. And then I'll again remind you of your wealth management apps, take time for your questions, then share with you the dates for the next investor update. Now, as you've seen this chart before, these represent, I'm going to change this because I meant to do the laser pointer because I found out I like that better. So as we have reviewed this in the past, we've talked about the cash reserves, we've talked about bonds as loanership assets, where you're loaning money to corporations or governments and they're giving you interest on that plus your money back. We've talked about how equities represent ownership assets, where you own, or at least a piece of, the companies that you invest in. Real estate, which again is also an ownership asset, where you own either the buildings where these companies operate, or you own the residences, multi-family, single family, etc. housing. You can make money as an ownership asset there. Tangibles, which would also be ownership, but they typically tend to be more connected to offsetting inflation and staying ahead of the cost of living. Could be things like energy, precious metals, or metals in general. Could be industrial metals, as well as commodities and such. Currency, which could be fiat currency, where you're using the US dollar against other currencies, whether it's strengthening or weakening. It could also be crypto for some of you who that's an issue, that's an important part of your portfolio. Again, no brokerage firm is able to work with crypto, but it's such a common conversation anymore that we can at least talk about some of the technical analysis for that as it relates to your portfolio. Business interests, which is about understanding how to invest in companies that are not publicly traded through alternative equity programs. Over here, you have equities of roughly about 6,500 companies that you and I can invest in. Over here, there's roughly 2 million plus companies in America. Most of them we can't invest in, but we've been building resources over the last few years to make it so you can invest in some of those companies and have business risk, much like the stock market, but very little market risk because these are not being traded in the same way as a stock would, much like what you're seeing in the markets today. And then finally, insurance and annuities, which they're primarily based on these same models, but they provide guarantees or riders, stabilizers, protection assets that make it so that you can invest and have some confidence that you have protections against either loss of principal or income as well. And as we talk about the concepts, cash reserve needs, I had some great conversations today with clients about what's cash reserve versus what is having access to money versus having protection in your assets, more like a surety versus probability, which is right here. Probability and surety, any investment that is subject to market forces has probability attached to it. Any investments that are more stabilized or have protections or riders in it, they're more surety or assured in their modeling. Income and growth, or income to growth ratio, which is understanding what your income needs are versus being able to invest the remainder of your assets in markets more connected to what your risk tolerance is. So for instance, if you don't have any real income needs from your investments right now, then we can invest all of it over towards what your growth or risk reward analysis says makes sense for you. On the other hand, if you need to have income and need to know that has some stability to it for the next 3, 5, 7 years, that's what this model's over here to do, to make sure you can have that confidence about your income and leave the rest of your money invested according to your needs. Tax management, obviously anybody on this call who pays a lot of taxes is always interested in how to reduce what they're giving to the IRS. Risk tolerance, how to make sure that your risk tolerance and what in your heart and in your mind, they match what your portfolio is, that we build a portfolio, whether it's assets we're managing or assets that are held away, that are helping you achieve your investment goals and hopefully be able to have a good night's sleep at the same time. Diversification, not putting all your eggs in one basket. Dollar cost averaging, maybe something we'll talk more about in the upcoming weeks and months based on how the markets and the economy performs. Asset cyclical management is understanding how there's always a peak and a trough to all asset groups and understanding how to invest accordingly for that with what we call weighting and weighting, how heavily to weight any particular asset group in this mix, and then how to wait through the process of when to get in or get out of it and when to buy back into it again, not on a day trading mentality, but more on a trend trading mentality. Not just to buy and hold, although there's plenty of places where that can make a lot of sense, but there's also plenty, especially in volatile markets, where it makes more sense to look at a weighting and weighting model. And then finally, entry and exit strategies, which is what I said a moment ago. We're going to talk more about how we work with entry and exit strategies to make it so that we're building your portfolio in a way that models what you need, but at the same time doesn't take us down the hole too far, making it hard to get back out. So let me show you here. When we talk about entry and exit strategies, it requires us to recognize 2 points: fundamental analysis and technical analysis. Fundamental analysis, and here is the textbook definition of it, which is measuring the intrinsic value related to economic and financial factors for any security. What I would say the simple version is this: to be able to have an understanding of the fundamentals of any company, to make sure that you feel comfortable that you should invest in that security. The question for fundamental analysis is always the same: should I invest in this security or this company? Does that make sense? Technical analysis, which is identifying disciplines to evaluate particular activities, economic, trading activities, market issues, to determine, should I invest in this security today? And that's really the big difference. This is saying, yeah, I'm comfortable. This is a good company. This is a strong company. We think has a lot of value. I'd feel comfortable to invest in it. But the question on a technical viewpoint would be to say, should I invest in it today? Because it may be perfect to invest in because it's a solid company, but there's also a time to either A, get out of it, and then there's a time to buy into it. And I would also throw in there, if you have securities that maybe aren't doing as well at any point in time, but we'll say right now, the question really becomes, do I still have confidence fundamentally that this is a strong company? And if I do, then maybe the question is, should I add more to it? Or maybe the question is, should I get out of it now and come back in later on when the analysis for the peak and the trough, the cyclical asset management modeling identifies it's time to get in because it's starting in the early upswing. And that really kind of brings me to the next point here, which is on the cyclical nature of investments, we always have a peak and we always have a trough. And in that, we have an early downturn, and then we have a full-on downturn, then we go into the trough, then we move into an early upswing, and then an upswing, and then we're at the peak. Everything, whether it's interest rates or the stock market, the real estate market, precious metals market, all items, whether it's US currency, they all have this cyclical viewpoint to them when it's going well and when it's not going well. Ideally, it'd be wonderful if we could get out at the peak and buy in at the trough. Realistically, it's not that simple. Nobody knows that. And when I say no one, I'm very confident to say no one does. Because if you take some of the biggest names on Wall Street, if they could identify the peak and the trough, they would only have one mutual fund. They would only have one exchange traded fund. You wouldn't need anything more than that because they would know when to get in and when to get out. But the reason they have so many is because there's so many asset groups and there's so much measurement to try to stay on top of, that what you can do is identify, well, when is this early upswing or when is this early downturn to get out? Now, since some of you might say to me, well, Frank, I think we're at the peak now, and we're certainly in that early downturn. Well, that could be right, but it may not be right. And there's a number of technical aspects that we look at to try to determine whether this is that time or not. And unlike the pandemic, which was a very fast, a very aggressive, violent reaction that the markets experienced as it began to understand what the pandemic meant, most downturns come as a result of a process, meaning it can take months to actually figure it out. In 2008, 2007, 2008, that period of time took about 6 months to identify that it was definitely time to get out. We moved from a cyclical bull market to a cyclical bear market, and from the downturn back up to where it hit some of the indicators we look for, and then that turned and went south again. That was that period of time when we said, you know what, it's time to go ahead and pull back. And because we waited and were patient in that process, we actually were able to have less loss and more gain as part of that process. Compared, say, to the pandemic, when it happened, it took about 7 days to make that decision because there was not enough information to make solid decisions about it. Another piece that I would throw into this mix is the fact that with the pandemic, we were worried about a recession that would come as a result of this downturn, what the pandemic might do. In 2008, it took a while for that to show itself, but when it did, it lasted, as it's called, the Great Recession, for a much longer period of time. We saw that again earlier in 2001. So the reality is what we're looking for is not just simply volatility or moments when the market pulls back, but actually we're looking more for the economic tools fundamentally that say this really is done. We are in this early downturn and going to go through a process which could take, again, on average, about 18 months is the length of most bear markets before that happens. So, you know, we've had a couple of weeks here now where it's been challenging, but is that really the end? Well, time will tell. I'm not comfortable to make that decision yet. If you are, then we need to talk about it. And since you're the investor and we're the advisor, if you say, oh, I can't take this anymore, I've got to get out, well, then we'll take a look at that. And hopefully tonight I'll be able to show you how we can make that adjustment, rather not just simply get out, but make some adjustments accordingly. And that's all understanding the cyclical nature of investments and how the peak and the trough, we'll call this 12 o'clock, we'll call this 6 o'clock. Are we at 12 or at 1 right now? Are we at 11? Where is that at for different asset groups? So how do we do fundamental technical analysis? Well, let me remind you that one of the things I say pretty regularly is that we work very hard here to be proactive wherever possible and reactive whenever necessary. So we don't simply operate with a buy and hold mentality. We operate with a grow and protect mentality. And being early in the year, I've had the honor of going to a number of investment advisor seminars and symposiums talking about where everybody thinks the markets are going, where everybody thinks everything's headed. And again, I would tell you that some of the biggest names and biggest firms that you could think of, they're working to identify what are the best options. But if, for instance, we're in a large cap mutual fund with, you pick the name of any company, any investment firm that comes to mind, their large cap mutual fund has to stay large cap. It cannot simply change because large companies are now taking a bloodbath because of the market or the economy. So they can't be proactive wherever possible, except in the large cap market. The same thing be true with small cap, or the same thing be true with international. They can't just simply become domestic because and stay only in America, because they are forced within a parameter of how to invest according to the prospectus or the PPM that they've handed out to all of us. They have to stay in that model. So what they do is they are as proactive or reactive as they can be inside their little sandbox. So what we do is we take a look at the overall sandbox as we build diversified portfolios to try to take advantage of opportunities, to be proactive whenever we see opportunities, and to be reactive whenever we have to be. So how do we make those decisions? Well, I'm going to suggest that the first thing we do is internal informational analytics. And that doesn't mean that we talk amongst ourselves. We have a number of firms that we work with. Some of them you heard before, AssetMark, JP Morgan, Vanguard, Fidelity. We have a number of internal firms that we work with that they provide some of the underlying investments for our various programs. And we use their information internally to say, well, this is what they're anticipating. What do we think about that? And use that as sort of a guide to how we're going to go forward over the next month or quarter or year. But we don't just stay there, because I don't want to just work only with who we know. We also pay, where these come with the resources we use in all those various firms I just mentioned. We pay outside firms to give us information as well. We talk with companies that bring on different pieces, and we pay them for that information, because we don't want to just listen to the echo chamber of who we talk to. We actually want to hear people outside of that echo chamber, to hear what they're saying. And so whether or not it's stock charts or Motley Fool or disruptive technologies, we use various firms like that to make decisions on other aspects of what we hear. So we have both internal analytics and we have external analytics to help decide, do we need to take some action now or not? Now, interestingly, over the last 2 weeks, I will tell you, it's been pretty silent. There's been a few articles here or there from various companies and various organizations. Most of it, if you read it, it's just kind of like noise, where it says, well, this is what it's been, this is what we're anticipating, this is our expectations for the analytics of everything. But we're gonna have to wait until we get through this. This indicator says this indicator says that, but it's too soon to make a good decision yet, which I would agree with. But still, as everybody's going through this volatility, ups and downs, and these big swings in a given day, it's important to recognize that we have to make sure we've got good information, not, again, buy and hold, but actually more grow and protect. So we're looking at, well, how much protection do we need to do right now? And are there any opportunities that we should be looking for? And then finally, the last piece is team analytics review. So we're getting internal information, we're getting external information as we're trying to figure out entry and exit strategies. And then not only do we pay for information from resources, but we pay for the analytics that we can get a hold of to make it so we can identify what we think is happening, which I'm going to go through some of that with you tonight. Because these team analytics show us items that we use for entry and exit strategies. I'm going to show you a little bit about how we do that, because that's really critical. If I'm just going to do a buy and hold mentality, it doesn't really matter. I can just stay like I am. But if I'm actually trying to take advantage of opportunities wherever possible and react accordingly wherever necessary, then we have to have information that gives us confidence one way or the other for that. So I'm going to show you some of that now. So within the groups that we work with, outside of the groups we work with, and then we make our own final assessments for what we're going to do based on what we believe is happening and based on what they're doing internally, whether it's an AssetMark, which is making minor adjustments along the way, but we decide to make big adjustments, or it's a Lincoln, or it's some of the various Pershing accounts we work with. They do some work internally, and then we finish up with the external work. They work off of what we tell them we want to do, and then we make the final decisions for that, because we have to also do our review as well. Because while you're expecting various companies to do well with us, the reality is that you're going to ask me why it worked this way, and I want to make sure we've got our ducks in a row, if you will. So when we take a look at enter and exit strategies, and I put this on here not because I expect you to hang on to all of this, but rather to kind of give you some of the pieces that we look for when we're doing our own analytic review of various securities. This just happens to be the S&P 500. I just did a cut and paste of that chart here at midday and said, okay, hey, where are we at here? So I want to point out a couple of things that we look at as part of our decisions on how to manage. And the first thing is relative strength indicator. And again, you can tell that there is a center line for it, and then a bottom and a top. And if I were to pull this up here, you could see that it's obviously below the 50 percentile, and it's down in that bottom half right now. Other times it's running up, and you drop down below, you can see comparatives on what that looks like. And again, we go back here, this is the pandemic, and so you can see where that broke below the bottom line, the bottom 25 percentile group, and we see some of that over here. The question is this just reactionary like it was during these times here in 2020, or is it something more than that? I'm going to come down here, MACD, which stands for Moving Average Convergence to Divergence, which is identifying 3 different moving averages: a 12-day moving average, a 26-day moving average, and a 9-day moving average. And what it's attempting to do is to identify shorter term, but not daily, modeling to determine what kind of risk we're dealing with. And you can see here, most recently, we're below the 50 percentile, which again shouldn't surprise anybody. But then the question becomes, is like back here, so it drops below, that's to be expected. But then what happens here to break up? So what you can see is these lines here represent the 9-day moving average. And so the 9-day moved up first, and then we had the 12-day, and then the 26-day move up. So right now we're looking at this piece down here, and we're like, oh, well, you know, it's below. But you'll notice that pretty quickly the 9-day moved up, and then it went back down again. Now, again, we could sit here and talk all day long about what all these details mean. What I would say to you is any single piece that I tell you, think of it like a word in a paragraph. And if I pointed at one word in a paragraph and said, tell me what this paragraph's about, if you couldn't see the rest of it, you really wouldn't know. I wouldn't either. So all of these are pieces that we look at, little dials and gauges, to try to get a handle on what's really happening. So don't let this throw you off that, okay, this says this and this means this. It's just 1 or 2 words in the whole paragraph. This area here, this is volume. And you can see during the pandemic, there was huge amounts of volume. You'll notice here, volume's been flatter. It has bumped up a little bit, but it's still kind of holding down. It dropped back here. And that volume had more to do with buys rather than sales. People were not buying as much then. And then you can tell there's a little more red here. So there's been more sales. So when you have money flow out, it's going to force the markets down. When you have money flow in, it's going to force the markets up. So again, in some ways, this is somewhat of a lagging indicator, but at least gives you some understanding that, well, this volume is pretty consistent, maybe a little tiny bit higher, but not necessarily that bad. There's been definitely different times in the late 2000s and in the early 2000s, 2001, where we saw much greater volume. Now, the last issue here has to do with the daily activity, which you can tell here. The black means it's going up and the red means it's going down. This red line here is the 200-day moving average. The blue line is a 50-day moving average. And you can tell that, for instance, this is pandemic, the daily activity plunged through the 50, through the 200. It tried to come back up and break through, but it couldn't because the pandemic fears were too great. And so it continued on down, plunged down to here, turned around, head back up. It broke through. This is May roughly of 2020. It broke through, headed up, then broke through the 200-day, continued on up, came back down, started testing it again. So these are all pieces of information. Pretty soon the 50-day moving average broke above the 200-day moving average, and you'll note there was a slight downturn in the 200-day moving average, which is a very long moving average. As a matter of fact, it's probably the oldest moving average that anybody ever follows, all going back to the 40s and the 30s and so on. This is what the old timers would look at to try to decide, should I be in or not. The 50 days, a shorter moving average, and it just kind of gives you some insight into what's going on. And then how it breaks through above or below gives us more insight. Now, what I added to it is these lines to kind of help you identify how the highs, are the highs going up? In this case, they were. Are the lows going up? In this case, it was. Those are indicators that we look at to say, well, even though, we're seeing a lot of volatility, it's still overall moving up. Same thing is true here. This is moving into 21. We saw it moving up. We see the highs getting higher. We see the lows getting higher. Here towards the end of 21, we see there's this pullback a little bit, then it breaks above. Again, the highs continue to move on up. We have this period of volatility for approximately 6 months or so. And then it moves on up. And then most recently, as it rolled into January, we can see it broke down. It broke through the 200-day moving average, 50 and the 200, broke up, ran into the 50. And this is another interesting piece of information. It runs up, hits it like it's a ceiling, bang, turns around, heads south. That's an indicator that the buyers are still not excited yet. Then breaks down. It broke below the 200-day moving average again. And now what we look at over the next few weeks, months maybe, is what does it continue to do? Because you can tell that the highs are moving lower right now, but you'll also notice the lows are moving up. Now, why is that important? Well, let's go back here. So there was a spread between the highs and lows, that the highs were getting higher and the lows were still going positive, but they were not they're not on par with the highs. But then you'll notice here that they kind of were similar, like it was trading some sort of a channel. Well, this particular time, what we see is the highs are getting lower, but we see the lows are getting higher. So what that means is it's going to get to this point where it's going to converge, where the daily activity is going to, and the 50-day moving average and the 200-day moving average are going to bounce into each other. And at that point in time, the market will either go higher because there'll be more buyers, because new information will cause them to feel comfortable, or to go lower because there'll be new information and investors will say, oh, this is not good, this is terrible, and that will cause them to sell more and the markets will go lower. Again, all we can do is watch this and then try to make decisions on what we think are the best options for that situation. It's not like one day we know the answer. It's really just a lot of words in the paragraph that causes to go, I think this paragraph says things are getting better, or I think this paragraph says things are getting worse. So I would say to you at this point in time, I don't have a solid answer. Do I see potential risk? Sure, I do see potential risk. Do I think it could be long-term and bad? Yes, I mean, there's certainly reasons to think that. But would I say that I am convinced that the bull market's over right now? I'm not yet. I'm not. And we'll be looking over the next 30 days between now and our next investor update to make decisions on whether we think things are getting worse yet or something we need to do differently. It's possible some bad things that could happen would cause me to make decisions before that happened, much like the pandemic caused us to make some very, very quick decisions. It's possible here too. I wouldn't say to you it's not. Certainly could be. Do I think that's what's going to happen? I don't, but I am watching carefully. If Russia does invade Ukraine, Ukraine's a tiny little country, it could have some impact on some of our oil and the spending and such. It's possible. Will it be the end of the markets, the economy, and what's been moving forward? I don't think so. But there could be some behaviors by various countries in this process which could create a problem. Could it be that it's not necessarily bad, but it starts to flatten out and we go through a period of time where things are say more flat? There's not really a great example on this. I suppose this is the closest we get to being kind of flat. Could that be what it is while people try to figure out what it is? Could be. Will it be this big dive like we saw during the pandemic? I don't think so. But I would say this, the one thing that probably weighs heaviest on me is the thought about recession. if there is indeed a recession, I think the markets, and we'll see that economic downturn as a huge problem. On the other hand, we find the Federal Reserve saying they need to raise interest rates to slow the economy down. You would think that if the economy was bad, they wouldn't be thinking about slowing things down. They would be thinking about, taking hands off of it and letting the markets, letting the economy have some freedom so it could go back up again. But again, there's a lot of moving pieces here. So what we're doing, what this would be, is technical analysis. Everything I've just told you is technical analysis. Fundamental analysis, whether it's about the US economy, the world economy, whether it's about particular industries or particular indexes, whether it's about breaking down to particular stocks or companies themselves, that taking a look at those would be fundamental analysis, which we've covered in other discussions. This is technical analysis, kind of gives us some indicators on what we think is happening, and then based on past history and statistical evidence, what we think will come as a result of that. So I can tell you at this point in time, I'm not nervous, but I am careful. I'm not feeling this need to get out, but I would also say that if any of you say, I just don't think I can handle this, we take a look at your risk reward scoring to make sure that we're in the right place. And if that, after that, you're like, I still like to get more conservative, obviously that is exactly what we'll do. But for right now, I am of a mind that the technical analysis supports holding on a little bit longer. And when I say a little bit, I don't necessarily mean days or weeks, months. I don't think there's enough solid data yet. And so now let me break that down a bit and show you what I mean. So far in our discussion about entry and exit strategies, we've been talking about fundamental analytics and technical analytics. But now let's actually take a look at some of the markets and the indexes on how they look, not just with what I showed you a moment ago, but something a little more interactive. So let me change. There we go. All right, so this is the Dow. And for those of you who are watching today, you probably noticed that the Dow went down. It had a pretty big fall, about 1.4%. That was about 482 points right up here. This is looking at it from a 6-month window, which I'm fine. You'll notice that the daily activity has trended below, broke up, tried to break above the 200-day moving average, wasn't able to hold it, went down, bounced off of, I'm sorry, the 50-day moving average, that's the blue, bounced off the 200, went back up, couldn't stay above it, and so it's come back down, came back up and hit it, right here it's hitting it, and then it's turned down right now. Now, let's deal with a couple of terms here that are part of the analytics for this. So again, this is daily activity, this is the 50-day moving average, and this is the 200-day moving average. When it breaks through here, it's breaking through the two averages, and then as it gets down here to this place, and if you follow this line across, you'll see what we identify as a floor of resistance, a floor of support, I'm sorry, a floor of support, which indicates that for the market to break below that support level of these previous downturns, it requires people to be more uncomfortable. Now, if you follow over here, you'll see that today it did break below it. And so now the question is, does it hold or does it move back up again? Tomorrow could be a buying day, but depending on information that came out today, it could be different. It's just going to depend on a lot of factors. Now, when it breaks based on this floor of support, it comes up and hits the 50-day moving average. Well, it hits the 200, then it hits the 50, and you'll notice it doesn't go above because now this is what's called the ceiling of resistance. It takes investors to be excited and confident that the markets are going to go forward before they're going to invest more. And you'll see it ran up, hit that ceiling of resistance, turned around and came back down again. It bounced off the 200-day moving average, which was a support level, then turned around, broke back up, couldn't stay above it, came back down, broke through, etc. This is a lot of words in a paragraph that at this point don't really still tell us anything because we have such a short period of time here. We're looking at from January till now. So we're talking about roughly 6 weeks, and there's been this volatility in here. If you remember from my last webinar, I told you we're expecting volatility this year. We've got various things to deal with, one of those being Russia and Ukraine, another one being inflation, another and rising interest rates if the Fed is going to try to turn that back on again. Those are pieces that the markets and the economy will deal with. You may have also heard that many of the states and the current administration are talking about how maybe COVID's over or nearly over. Well, that's going to then help get the economy and the markets moving again as well. Mask mandates may be going away as they are in a number of states now. There could be other things that will come from that. Supply chain continues to improve and improve. There's been things that I couldn't get 2 or 3 months ago that I can, and I know that's anecdotal, but I'm not the only one that's saying that. We're finding that we are working out processes to get more and more stuff back onto the shelves at our favorite stores and such. That's all supply chain issues working out, which will again speed up the economy. So it's not as if there is just like an overcast sky out there. There is a blue sky with a lot of opportunity, and there's some clouds of doubt that are out there as well that we have to watch. Now, this is a 6-month window that I'm showing you. Let's take this to 2 years so we get a little broader view of what's happening. And again, you can see this pressure here. So this is the high that we've seen, the highest of the highs. And so now we broke down, and that's just a tighter version of what we've seen, a smaller version, because we've expanded it for 2 years. If we go back roughly here, that's the pandemic. And so our measurements, as I'd mentioned before, run across here. So here are floors, support levels. And so what we're really watching as another important word in the paragraph is, what does the economy, the markets, in this case the Dow, what does it do with the previous support levels? The Dow, for I think all of you know this, but it's the 30 largest companies in America broken out by several industries. It represents a pretty strong basis for those big companies, and it's continuing to hold its support levels. What will it do over the next week, 2 weeks, month, quarter? That's part of this discussion as well. So again, while it's still above where the markets were before the pandemic, it's still sort of testing these lows, and it's not the first time it has done that. It has done that at previous times as well. This is during the pandemic and what was going on there. So here we are, we've come up. The markets, if I were to kind of judge this, I'd say it's tightened up a bit, and then it broke above, broke above again. Now it's kind of testing it. Inflation, supply chain issues, global geopolitical issues are kind of part of what this is about right now. I think that if a person walks into this discussion and they're already feeling like, oh, it's over, various political issues are destroying it. There's a number of reasons I could build to go, well, this is why it's over. And I can see why a person would think that. But I could also build a lot of supports to say this is why it wouldn't be over yet. I think ultimately in the end, and that's coming back down here to volume again, with volume, if we have more sellers than there are buyers, the market goes lower. And if we have more buyers than sellers, the market goes higher. And what investors are waiting for is to get a feel for what's happening right now, and that might take them a month or two. Having said that again, though, if things were to rapidly get worse, we would begin taking a look at other options in that. So now let's take a look at a different index. We'll take a look at the S&P 500. And looking at it from a 2-year version. Again, you see a very similar pattern here. Roughly very similar, to be honest with you. This is the 500 largest companies in America broken out by the various industries. It did not break above the 50-day moving average, and it has broken farther below the 200-day moving average. But I would also say that support level, looking back over the last 6 months, is about the same. So we'd want to see what that's going to look like. we also would say, well, there's the high we've had. That would be the best we've ever seen. And so the question really is, back to my cyclical asset management, our trend thinking, is this the early downturn? Is this 12 and this is 1? Or is this just another step in the process, like some of these other times we've had pullbacks? What does this look like? Now, again, being that it's below the 200-day moving average, we give this a little more weight than, say, back here where it didn't hit the 200-day moving average. I would also identify here that when we're looking at this downturn compared here to the short moving average convergence divergence, not quite as deep as what this has been. Now, that could cause a person to go, well, doesn't that tell you that's the end right there? Well, no, because again, cyclical analysis is the markets, they can go on for quite a while and do well, and then all of a sudden they have to do some retrenching. Maybe like, and this is longer than a year or longer than a season, but for those of you, and I'm not one of you who does this, but for those of you who actually have gardens and whether it's flowers or vegetables and you do a lot of weeding, you know that you have to go out there and pull weeds and retrench certain things and replace certain things, and that's part of what this could be too. I don't think that's what this actually is, but there is this tendency to say, let's step back and see what's going on and see how with the new world economy, whatever that really means, how's it working? And so the S&P 500 has had sort of a different kind of view, a little more muted than, say, the Dow did. Now let's go ahead and take a look at the Russell 2000. So with the Russell 2000, and I have to tell you, I really was thinking that because this is the 2,000 largest companies in America, and there was so much that was happening that I really thought they were going to take off. I would point out that during 2020, so here's the pandemic, it broke above because there was so much flowing into the economy and the markets that thought the Russell 2000 would really take off, which it did until we got into 2021. And then in 2021, some other things happened. And honestly, I think that there's pluses and minuses to any administration, but this timing does really happen a lot around the election or the inauguration of the current administration, where it became this question of whether these mid-sized companies and maybe smallish kind of companies could continue to have the kind of resources they need to do their job. And so it flattened out. And you can see that our support levels there held for quite a while, but then most recently, as this downturn happened, it broke below those support levels. And even to the point where the 200-day moving average, the 50-day moving average has broken below those support levels. So with the Russell 2000, this would be one of those areas where I'm much more likely to say, okay, so the Dow and the NASDAQ has one set of things going on, but such a broad index as the Russell 2000, probably not going to be the thing where we want to stay as long. Maybe we'll hold until it comes back up a bit, which I expect to happen, but we would not want to follow this back down. We've made some nice money on it, so we want to hang on to that. And so we'd make some adjustments here when we perceive either A, we've kind of hit that ceiling, or B, we're not going to continue on any higher. I would also point out that we're looking at how it's running up to the 50-day moving average. My expectation is that the Dow and the NASDAQ and the S&P, if they go back up and break through this probably will as well, but that might be sort of the end of this discussion for a while on the Russell. Now let's go ahead and take a look at the NASDAQ, which is actually a very tight comparison because it's such a tech-heavy index now. So it's got the FANGs in it, Facebook and Amazon, the Alphabet, Google, etc. It's got all of those in there, and you'll see that it has actually broken below the 200-day moving average and has not even been able to go up and hit the 200-day moving average yet. A lot of speculation on what that could be, but probably has a fair amount to do with Meta, formerly Facebook, kind of struggling, and probably some of the issues about tech and how they've handled some censorship issues has kind of pulled back some of their profitability. At the same time, though, you've got Amazon and Netflix Netflix isn't doing as great, but some of these people are still doing a lot of resources there because it's not perceived in the same way as social media. But the bottom line is that we're looking at how it's also tested its lows, and I'm curious to watch what it does over the next weeks and months. Again, I think if the S&P and the Dow go up, I think probably you'll see NASDAQ go up as well. How that works though with these moving averages and the convergence and divergence through the various levels, that'll probably have a big impact on where we go there as well. So we've looked at NASDAQ, we've looked at Dow, we've looked at S&P, we've looked at Russell. These are all looking at sort of the major indexes, but now let's look at something that's a negative correlator or correlates negatively to these indexes, and that is the VIX. The VIX is a comparative from the Chicago Board of Exchange, and it's based on options contracts, which are typically thought of as 90-day windows, going up or going down. And so people that are investing in options, meaning puts or calls, puts believe the market's going to go down, calls believe the market's going to go up. What we can do is, and I'm going to make this a shorter version so it's a little easier to see. Let's turn this into 6 months. So now what we see is something a little different, which kind of supports some concerns, although I would say that it's not, again, another word in the sentence or in the paragraph, but it does kind of support that if we look here, the lows are getting higher, meaning that it's going to move up. You'll notice the 50-day moving average is in a more positive movement, meaning that, and the VIX is sort of an opposite to the market. So if it's going up, that means it's an expectation that in the next 90 days, the market will go down. So if the VIX is moving up, it's a belief by futures traders that the market's going to go down. And so these lows are moving up. Now, comparatively though, these highs are moving down. But tomorrow, we might see something different. I was pleased to notice today that the market, while it had a negative, it didn't break up into here, which makes me think that even though the market had a big down day, it's not supported by a lot of the traders thinking, because they're not thinking this is going to be long term. Again, no one knows. I don't know. Fidelity doesn't know. The Chicago Board of Exchange doesn't know. None of us know what's going to happen. But if this had broken up above here, that might have been another word in the paragraph that would have caused me more concerns. I would identify also that down here in the short moving average convergence divergence, it's been pretty flat on the 9-day, but it has broken up here on the 12 and the 26, but not a lot. So again, I think that the longer term investors in options are probably thinking this isn't as long term currently. Doesn't mean tomorrow that won't change, but currently they seem to be a little more muted about what's happening. So if I take the information I was sharing on the Dow and the Russell and the Dow and the S&P and the NASDAQ, and I attach that sort of to the VIX, it causes me to say that there's not really a solid answer yet. And that would cause me to say, well, we might be at 11 o'clock, we could be at 12, or we could be at 1, but I don't see it as 1 yet. I don't see it as that early downturn yet. But I think this probably fits more with our last discussion, that this is about volatility more than anything else. So now let me do this with you. We often take a look at the 11 industries and a performance comparison on them to, in this case, the S&P 500. And as you may remember from, say, September and October, November, December, now we are January last month, and then February now, we had much more positive numbers here in these various industries. And now, while it hasn't gone negative, it's that the S&P is sort of matching almost all the industries, with the exception of staples, the things that we have to have, consumer staples, energy, which has been sort of reacting to pressures because of supply and demand issues, and technology, which is, again, back to my point on the NASDAQ, it's kind of interesting that even though this is still outperforming the S&P 500, It's not, the markets are showing something different on that. Now, we'll watch and see how that goes. If we take this out compared to the S&P 500, previous conversations, we've had none of these territory, and materials are out that for last year we didn't have any of these in negative territory. Now that there are being looking for the last 200 days negative performers, makes me think that these are the ones that likely will do well going forward. Again, it's sort of counterintuitive. You don't want to buy at the high, you want to buy at the lows. And so as I pointed out, and this is actually improved from last month, that while it's still negative, it's not as negative as it was before, because people are starting to look at industrials and how they're going to produce, and they're looking at materials and how the supply chain is going to adjust for the industrial start taking off as materials is needed. You're going to find that this is probably going to be some areas here that will probably take off again. Financials, while they're still not, they've actually come down too, but they're not negative yet. I think that's an area that's going to continue to move forward. And again, depending upon how everybody looks at energy, I think energy probably still has some more to go. Probably by the end of summertime or middle of summer, we might have some different thoughts on that. But for now, we look at it as a model and say, well, these are probably some of the areas to be looking at, not because they're negative and that should scare us away, but rather everything cycles. What's negative before becomes positive, and what's positive before becomes negative at some point. Nothing does this upward movement forever. So now going back to our charts again, let's break down some of those industrials. So I'm going to go back here. I'm going to take a look at industry. So let's take a look at just a couple of interesting industries. One of those is energy. And so what you'll note, and I haven't really taken much time, but for entry and exit strategies, we look in much more detail. So I'm going to drill down and show you a few things. But with energy, we can see that it's not just energy. What it is, we've got oil and equipment services, integrated oil and gas, exploration and production, pipelines, and coal. All of those are connected to energy. Now, not all of them, when we invest in energy, do we get access to, but many of them, we look at it and say, okay, these are some investment options that we can look at inside there. But just looking at oil equipment and services for right now, we can see that unlike what I showed you in the Dow and the S&P and the NASDAQ, we're not seeing this retrenching through the 50 and the 200-day moving averages. We're seeing this continuation upward, because it is one of those areas where, again, and don't forget, money flow determines direction. So if there's money moving into it, and you'll notice, so here's sort of the average of it compared to the previous months, there's money flowing into it because there's this perception, and I think it's rightly so, that energy is going to continue on up. It's well above the 50-day moving average and well above the 200-day moving average, and they're all in positive territory at this point, and looks like they're continuing to. This downturn may simply be nothing more than just the markets reacting as the markets do, wondering how things will fit. But again, your lows are getting higher and your highs are getting higher. Now, if we go back and take a look at, for instance, real estate. So on real estate, what I'm going to do is take a look at a couple of things here. One, I'm going to take a look at residential real estate, which you'll notice it actually was higher today as compared to the others. You might say, well, why is residential high and the rest isn't? Because there's so much need in this country for more single family and multifamily housing that it's one of those areas that I won't say it's recession proof, but boy, it has a lot of feeling to it. If we expand that out a little bit, you can see here that while it has had a reaction, it did end up positive. That's why that's black like that. It has ended up positive. You'll notice that it's below the 50-day moving average, but above the 200-day moving average. And overall, you could say, well, that's support and resistance, but it has tended to head up, and more than likely, it has to do with just market reaction, why it's down at this point. But I don't think that real estate, at least for for single family, multifamily, manufactured homes and storage, I don't think that story is over yet because there's just a need for it. Now, comparatively, just to kind of show you, and this is one of the things I like about the stock market as sort of the center of those 8 circles, not because I think the stock market's the best. Truthfully, real estate's done very well, not what I'm seeing here per se, but rather, you know, your house has gone up in value. If you own a building, that's gone up in value. Real estate has done very, very well over the years. But let's take a look here at something that we probably would all sort of think about, which would be retail. And so retail, as compared to residential, there we go. So retail hasn't had quite the same bump up. It has broken through the 200-day moving average. And again, retail, for it to have the value, and it will have value, again, if the local mall doesn't have as many stores or the local strip mall doesn't have as many offices in it, at least, you know, rented out, that's still valuable. It still has use. And so that will be one of those things that'll be working, but it hasn't done as well as for retail as the residential has done, primarily because there are more businesses that have closed. There's more landlords who are struggling with payments and so on. So even if we take a look at it over a 2-year period of time, we can see that it's come up. But if you were, so this is pandemic back here, it's just barely above pandemic. If I go back over to residential, let me just type that in. And we look at the same time frame, you'll see pre-pandemic residential is well above it. And I think if, again, because of this need for housing and so on, if you've attended some of the accredited investor updates where we talked with various real estate programs we're working with, they would echo that same thought. Oh, I'm looking at the clock here. Let me hit one more thing with you before I kind of bring this to a close. Let's go back. Okay, financials. Now, financials is interesting because the use or need of money isn't going to go away. And so financials tend to be one of those strongholds. And so I'm just going to pick on banks, for instance. I mean, we can look at asset managers, banks, financial administration, insurance brokers, full line insurance, life insurance. I mean, there's all of these various financials in there. But if we just pick on banks for a second, we can see that chart. It's been let me expand it for a second just so you can see the chart. Show you 2 years. So again, you can see that, again, pre-pandemic, much like residential real estate, it has done better. And I don't think that financials are over anytime soon. But here's what I would really point out to you. Let's go back. Because on all these charts, while I haven't really taken much time to show you, a few of you in the office I've shown you, but so looking at banks, what we can do is we can take a look at all of the banks that make up that particular industry sector. So you can see, and you'll notice over here, let's change this so we can look at a 6-month model. There we go. So you can see all of the performance, so 75%, 68%. You can begin to break it down by various banks. And you can see again, so performance 29%. And there's much more detail I could drill down into it. I'm not going to tonight, but these are the things that when we start looking at a volatile market, I think the tendency is for people to go, oh, we just got to get out and go to cash. That's our only option. That's not true at all. There are negative correlators, and then within various sectors, indexes, markets, and even industries, there's a number of pieces to go to that we can make a lot of options to portfolio management changes that will make it so that you can still make money in a downturn. And so I think the tendency for people to say, oh, I've got to get out of the stock market, I've got to go into cash, which is certainly one answer, but it is not the only answer. So when we break these out, you can see that 3-month modeling, what we have, various banks and so on. We can talk about the various indicators and how we calculate what we should do, etc. Even 1 month, we can see some options. So the point is this, and the way I would sort of close out what we're going to cover tonight is to say this, that I don't think there's enough information yet for anybody to panic, even though I know I've talked with several of you and you're a little concerned. I don't think that you should be concerned. However, if you can't sleep at night, then I am more than happy to move the portfolios to something a little more conservative so that you can feel better, because that's what we want more than anything. But I'm giving you my opinions because, quite honestly, I think that there are options here for you and for myself as well. So we are looking at these various sectors, these various indexes, these various markets to make determinations on how to build a portfolio and then how to manage it based on your risk tolerance and what your growth or income needs are. So let me kind of bring this to a close. So this was a little more insight into how we make decisions. And again, with anybody's portfolio, we can break this down for you. As always, diversification is not putting all of your eggs in one basket. Not in stocks, not in real estate, not in gold, not in crypto, not in private equity or alternative equity programs, not in cash, not in bonds, not in insurance and annuities. It's dividing it up in good models that make sense for your risk tolerance and your growth needs, and then having a process for how you make adjustments along the way when the economy or the markets or anything makes a change that causes us to be reactive, because we have to be, but proactive every time that we believe we're in that early upswing, and then reactive whenever we think we're in the early downturn. So nothing has changed, and I still feel very comfortable with what we're doing with what the economy and the markets, I mean, not we, but the investment portfolios and the management that we're using. I feel very comfortable with all of that. So it doesn't mean that I'm not open to options or rethinking it, but at the same time, I'm still feeling very good about where we are. As the next weeks and months go by, we can have more discussion about that. As a reminder, we provide you 4 complimentary wealth management apps to help you with the management of your wealth. And those 4 apps are your wealth management dashboard, which I know many of you are using and loving. We also have the Return on Life, or my FLP, Financial Life Planning, which takes not just the numbers of your situation. I'm going to turn on that pointer again. Not just the numbers of your situation, but really what you want to accomplish, how your family's desires blend with your family's wealth. The risk reward analyzer, called Riskalyze, we use to help you figure out how much risk you're taking and if your portfolio is appropriate for your risk number. And then your portfolio management dashboard. So this is everything, but doesn't have any, this has your banks and your credit cards and your 401k and your investments with us and investments outside of us. It has all that. This only has what you have with us. This dashboard shows you what we're doing with performance information, so you can make decisions on, I know, is this making sense, or is this matching what my needs are, etc. So this is how we help you to stay on top of your numbers. If you're not utilizing all these and you want to, just email me and I'll be happy to get that for you. Actually, Cher or Stephanie will get that for you. Okay, I see there's a couple of questions, so I'm gonna hit on a question and see what we got here. I'll have to do this now. I guess the red dot doesn't work if I do it that way. Nope, that's not doing it either. Okay, so we'll do it this way. There we go. Okay. Oh, thank you, Angela. Let's see if there's more to that, though. Is that a bigger question? Nope. Okay, good. Excellent. All right, wonderful. Well, thank you. That's very kind. I appreciate that. And again, my goal is always to help you feel comfortable and to answer questions and to drill down on what you need so you can feel good about how you're creating, growing, and protecting, preserving wealth. All right, if you have more questions, feel free to add those in too. I'm going to go ahead and just bring this down here. Here we go. Okay, so our next monthly investor update will be March 15th. And again, we're going to continue some discussions. I'm going to actually break down diversification more and show you how we use diversification sort of like an investment recipe to give you the growth you want that matches your needs, but also gives you the risk protection to match your tolerance as well, and how we're able to create different portfolios like an investment recipe that matches what your needs are. So we'll cover more of that in our upcoming modeling as well, or investor update as well. So what we've done so far, we talked about the asset groups and the investment concepts we operate off of. I drilled down on entry and exit strategies a little bit more for you, as well as diversification of the portfolio, at least teeing up the ball for next month. Remind you of the wealth management apps, please use those. I see we got another question. Let me see what that is. Okay. Yes, I did not see anything different, Kevin. Thank you. That was very good. And then I remind you of the next investor update. You guys are awesome. I just love you all. I really do. You guys are the best clients and friends in the world. Okay, so if you have friends that you would like to attend this, again, just let Cher know, or let myself or Stephanie or Kelsey or Alex, if you're talking to them, let us know, and we'll be happy to get them an invite to this. Everybody is welcome to come to this. There is no requirements. The accredited investor update, we have some broker-dealer requirements for that, but for this one, anybody can come. Anybody can come. So that's the information for tonight. If you have more questions or anything, please feel free to email me or call me. I'll be happy to take time with you on that. And as always, we're here for you. Right now, I got friends from New York who are so happy to be in Florida right now because they've been in New York for a while and they want to come down here and breathe some fresh air and have some sunshine. We're going to go have some dinner and everything. And I hope that you have a fantastic night as well. And I will look forward to talking to you soon. If you have any questions between now and the next update, please reach out, let us know. We're here for you anytime. I'm here for you. So have a fantastic evening and be blessed, and I will talk to you soon.